Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about our stock market investment strategy utilizing closed-end funds. So, to get the normal disclaimers out of the way, plus I'm going to tack at least one or two on. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company and sometimes I walk alone. And the extras for today are quite honestly, my head hurts, my throat hurts, and I'm not feeling exactly well and jolly like normal, but I will suffer forward and attempt to make this video and get it done. So uh let's see, the book information is mostly the same. It was on the book front, it was kind of a stalled week. My strategy was elsewhere employed. Um, did a lot of portfolio updating, did a lot more stuff on my end of things, but I'm hoping to get back into book editing this week. On the market, I don't know about the market as a whole. There's been a ton of noise from Fed moves to trade progress, but I think if you take a step back on the market overall, the picture becomes clear. So this week, the spotlight shifts to earnings season. Hundreds of companies are set to report, and those numbers will tell us a lot about how real consumer strength is holding up. We'll also hear from several Federal Reserve officials, which could move markets, especially after last week's tone shift from Jerome Powell. And if Washington doesn't act, and really if one side doesn't pick America, Thursday will mark the longest government shutdown on record. And yes, historically, like I get it. Right now, it's volatile and choppy, but historically, shutdowns cause more drama than damage. But we'll see how the sentiment reacts. The herd is finicky. We'll see how or I guess how skittered they look. Two, the Fed, one cut and maybe done for 2025. So yes, the Fed cut rates by a quarter percent, 8 months, really 11 months too late. But they cut rates by a quarter percent. But Powell made it clear he's not promising more. He said another cut is far from certain and admitted there are strongly differing views inside the Fed right now. The rare public split pushed the 10-year Treasury yield back above 4%, which means mortgage rates tick back up a little bit and now sit around 6.3%. Analysts overall say Powell's message is basically warning Wall Street to stop guessing his next move. I get daily updates sometime from Seeking Alpha on the Kalshi betting ring. Ring makes it sound like it's an illegal thing, but I get daily, if not weekly, reports on Kalshi and the betting odds on the Federal Reserve rate cut, and it's just become hype. So Powell's essentially trying to recalibrate the expectations, not hitting the brakes on growth just yet. Three, now I don't know if it's because I've moved everything to Fidelity or if just I'm getting more Fidelity email. But Fidelity sent me an interesting email. They had several topics, but the top topic was their 5 risks on the current market. But they're not risks. They're really fears. And here's what they sent me. Excuse me. Not my intention to burp on video. Um, Fidelity drops this list: high stock prices, overhyped AI, global instability, interest rate cut uncertainty, and debt stress. And they're more fear than fact. High valuation, yes. If you're investing in that Big Ten group of AI, yes, they're all overvalued, but earnings overall are still coming in strong. AI, it's early, but it's not a bubble. It's really the infrastructure building. Rates of debt, they're cyclical, not catastrophic, and global instability is always there. It's always priced in. So Four, what the Fed really did this week was they ended quantitative tightening, or QT. That's a big deal. And on their end of things, it sounds really wordy and jargony. On their end of things, they're no longer selling treasuries into the market, and they're redirecting MBS, mortgage-backed securities, and repayments into short-term treasury bills to stabilize liquidity. But what that really means is the Fed made a defensive move to keep credit flowing smoothly, not just to juice the market, but to keep it from seizing up. Five, the US China trade talks went better than expected, or at least I thought they would go well. The media at large did not. Um, but yeah, overall, positive note. President Trump called the meeting a 12 out of 10. So here's the short version: tariffs, some reductions in exchange for action on fentanyl exports. Rare earth material. China agreed to keep the supply chain open, which is huge for tech and defense manufacturing, especially now that the US is trying to compete and supplant China as being the tech capital of the world. Farm products. China will start purchasing US soybean, sorghum, and other crops again. And then energy, there's a potentially large scale deal, including oil and gas from Alaska. But no official trade deal has set yet. Negotiations will continue, and both sides want to win before the next summit. Six, the bigger picture, really rates, growth, and strategy. So, despite the noise, US recession odds have dropped, especially after the Fed resumed cutting. GDP is still solid. I've seen reports it's gone up. The 10-year Treasury yield is easing currently at 4%, and that's great for bond investors and closed-end fund strategies. Lower Treasury yields mean bond prices rise, and closed-end funds are still paying 8 to 10% in many cases. Current yield overall for the entire set is about 8.5. And meanwhile, consumer spending remains hot, and energy demand and just energy in general is rising. So both strong signs that the economy's not cracking. Seven, shutdown drama and market volatility. The government shutdown has stalled per new data reports, which leaves the Fed kind of flying blind. Yeah, with the government shutdown, the Fed's not getting, I won't say accurate data, but they're not getting data that's readily available. Question being, do you trust the government at any level on the data it's supplying? But markets in general don't love uncertainty. So we've seen volatility tick higher. And I'm going to sneeze at some point, so I'll apologize for that in advance. Excuse me. Adding global tension, like the strikes in Gaza and Venezuela, plus the corporate layoffs from UPS and Amazon, and all the shutdown talk. And you've got plenty of headlines for the herd to panic over. But if you zoom out, GDP is still positive. Real estate remains steady, and long term investors aren't flinching. Housing, rent, closed end fund dividends don't care about DC drama. And that's why they anchor wealth better than hype, or better than the hype cycles do. So the market's bouncy. Gold spiked, then dropped, crypto's swinging, and that's all just short-term stuff. The real opportunity comes from strategy and not reaction. Keep your portfolio trimmed and targeted, diversify where needed, but don't diversify based on fear. Instead, stay focused on cash flow and don't let the headlines dictate your decisions. So let's check out the closed-end fund, the CEF breakdown for the week, and we'll see how that fits into the ongoing strategy of bonds, AI outside the big guys, and energy. So to share that list, and hopefully not sneeze again or cough again. Coughing would not be fun. So that's this list. I have not sorted it. And no, I did not do the entire closed-end fund system update because, quite honest, I didn't have 8 hours to do that today. So I updated my normal targets, and I will get to updating the entire system at a later date. So I left it at this, and I ranked it based on yield, but we can rank it based on discount if you want, but they're all triple targets. So it comes down to the normal sort. I want monthly unless there's a good reason for justifying a quarterly payer. DX might be great for volatility, but it's not great for volatility when it's volatile. When it's peaceful sailing, DX might be a great idea, but now everybody wants it because it's great for volatility. Madison, I don't know a lot about, but at the same time, I'm not a huge fan of portfolio when it can. And the Gabelli Fund, it's a category three, it's small scale, it's still portfolio McCann based too. USA, I would leave on there. So now we come to yield. And I think we have to demand yield within reason. So if I set the metric above or at 9 and above, that really gets rid of a ton of the list. You could argue, you'd make a good case. You could argue for NML, you could argue for KYN. Both currently paying below the metric, but both also on the initial cusp of the energy revolution and the AI revolution. And those companies they are toll booth operators, and they own a lot of energy, right? They own a lot of utilities. So I think we could make a case for them. So I'll at least leave them on the list, even though they don't hit the 9% metric. The other is HFRO, and it's really because it's the biggest dividend. On my end of things, it's well above my existing average. I don't want to add anything to it. They also haven't added to the dividend, but it's well positioned going in like it's been, I mean, in the current market and the coming market. So then that leaves everything else above 9%. But I think we can skim out the CLO market and Hicks. Hicks does well, pays a fat dividend, but it doesn't beat the benchmark. So it looks amazing, but it's really not. Let's see what else. River. I'm not a huge BlackRock fan. Um, and it's very portfolio when it can. EIC is CLOs. NMAI is interesting if you're not if you're looking at the declining dollar value and you want to go outside the US. I can get why you would pick it, but that's not me. With money piling into the US, I'm still into piling money into the US. I'm not a huge Aberdeen fan. Let's see. I don't know enough about this company. PTY, Double Line, our brand name, or we'll say PIMCO, and DOY are brand name funds. DOY is cheaper than it's been for a while, so it's a great buy. And these two, there used to be three exceptions to the asterisk list. There's really four, and it's because they rarely go on discount. And by rarely, it's like once in a blue moon. And it's so rare that when you pull up their pricing, you're not going to see it on the white shot. So if we look at their current average, you look at 427, that's below the current 442. PTY's got a steeper or a greater discount, but it doesn't look like it because the average in general is close to 21% premium. Currently, it's 6% off. CIF is a wave rider. So we're left with this. And it really comes down to your own strategy, really comes down to your current holdings, and really comes down to where you think the market is going. If rates continue to drop, bond prices will rise. Maybe individual bond funds will lower their dividend payments. Closed-end funds don't. And of course, my sinuses and everything are draining at the moment, so I apologize. U.S. stocks, I think, are a great option, especially on the dips. USA is a great buy. It's a better buy now than it was 2 months ago because I want to say like mid-November is the ex-dividend date for its first dividend in January. So holding it, like buying it in October, right, or even September because it pays in September, but the ex-dividend date is before September. So buying it at September, October isn't that great because you've got to wait so long to get the first dividend payment. but it'll go. I want to say it goes ex dividend in about 2 weeks, and it's cheaper than it's been, and it is a cyclical thing. So their bounce patterns, USA and ASG both are like this, and depending on your strategy, excuse me, your overall strategy, you're either buying it when it's low, keeping it when it's high, and just kind of buying that cycle, or you're buying it when it's lower, selling it where it's higher, etc. Um, let's see, Pimco is brand name. You're gonna get a great fund. Double Line is brand name. You'll get a great fund. HGOB, I think it's still a little high in the grand scheme of things. Uh, Newberger is high, but they've also raised the dividend. I like that. These three, I mean, NML and KYN are great picks for the coming market. They're great right now because, like, if you were just buying into them, they're fairly cheap at the moment and they're looking great coming forward. On my end of things, both are valued higher than where we bought them. So if I'm demanding a 9% yield, they don't make my list. But that's kind of up to you and where you stand on that. But if we're buying tomorrow and we're not, I made a video yesterday about what we've bought recently. If we're buying tomorrow and we're not, I still think the best plays are the top three. You look at BRW, bonds and crypto, FCO, which is bonds and business development, USA is powerhouse blue chips, and then you can make a case for everything else on the list. It really just depends on your individual strategy, where your portfolio is, where you're already invested, and so on. So I don't like leaving a lot on the board, but at the same time, I want to give you options. So I'm going to leave it at that. And of course, my nose. Of course. Like it's nice to have it finally drain out. Not meant to gross anybody out, but at the same time, of course, it would happen on a video. So, in conclusion, if you're tired of the hype and you want to hear real strategy, not the crap that, like, I like Fidelity, don't get me wrong, but Fidelity obviously doesn't listen to strategy, or at least have the same strategy we do. So if you're tired of the hype and you want to hear real strategy, not fears wrapped in facts, and just it's just not me. So if you want real strategy, not headlines, subscribe and follow. And I'll keep cutting through the noise so you can focus on what actually moves your money. So that's all I got for today. As always, if you like the content, then yes, follow and subscribe, recommend the video for someone else, and help somebody else in their own financial journey. So I wish you all a great week, and hopefully I am doing a lot better next weekend. So have a great week, everybody. Bye bye.